Welcome back, everybody. We are joined now by our very first team, Paragon Capital. Team, congratulations on making it to the finals. You will now have 10 minutes for your presentation today. If you go over 10 minutes, I will unfortunately have to cut you off so that we have time for our 20-minute Q&A. I will be starting the timer when the first person begins speaking. Best of luck.
Good morning, judges. My name is Lily, and alongside Alex, Victor, and Harrison, we are here today to present the Paragon Capital Decarbonisation Plan for Super Easy superannuation. To begin, in line with current world trends, Super Easy runs the risk of not meeting its climate milestones to avoid the significant impacts to its portfolio at the hands of climate change. Shown here on this slide, we see the current policy trajectory in green is not enough to mitigate the severe impacts of climate change on the global economy. Not reaching the target trajectory runs the risk of the world experiencing significant climate risks. These risks will then flow on to impact member returns as assets will be faced with transition and physical risk. An example of this is demand shift away from fossil fuels.
At present, Super Easy does not have a net zero strategy to avoid these risks, nor has it pledged action in line with industry peers. We believe this lack of strategic direction on behalf of Super Easy represents a significant threat to the key value proposition offered by Super Easy to its members. In line with emerging trends within the pension industry, Super Easy should look to implement a net zero pledge and work to employ a strategy towards reducing the emissions of its portfolio in line with that pledge. To meet this strategic goal, we as Paragon Capital advise Super Easy adopt a clear 4-stage solution towards net zero. As highlighted here, the proposed strategy offers a strong investment performance, averaging almost 7%, a Sharpe ratio of 1.05 by 2050, and successful decarbonisation of the portfolio by 2050.
Begin the transition. Paragon Capital recommends Super Easy adopt the pledge listed on the slide to completely decarbonise its portfolio by 2050 in alignment with the global commitment under the Paris Agreement. In addition, Super Easy should further commit to a negative total absolute emissions pledge for the fund by 2070. Finally, we recommend Super Easy commit to annual TCFD-aligned reporting of its progress towards net zero so that members can keep Super Easy accountable for its investment choices.
Diving deeper into the strategy, the 4-stage pathway will enable Super Easy to align its objectives in stage 1, transition the portfolio from the current weights to the proposed weights in stage 2, engage key stakeholders to drive alternative investment strategies through active stewardship in stage 3, and finally tackle the long tail residual emissions using offset retirement and procurement in stage 4.
Moving on, we see that the proposed allocations for Super Easy's portfolio for each of its stages here on the left. Of note is the rising allocations towards infrastructure and real estate, and the underweighting of fixed income instruments towards the end of the 2050 horizon. On the right, we see a stage-by-stage breakdown of the emissions pathway towards net zero, and this is driven by key themes throughout each of the major stages that focus on reducing climate risk and maximising climate opportunities.
Stage 1 of the proposed net zero pathway involves setting a clear mandate for internal and external stakeholders. To do so, we recommend Super Easy implements robust greenhouse gas accounting in line with Partnership for Carbon Accounting financials to enhance transparency. We recommend that PCAF reporting is made a condition of investment for portfolio companies, helping to align them to the unified standard. As the first stage of active stewardship, a key outcome is to stress to portfolio companies that net zero is coming, and it is well supported by the world's largest asset managers. In addition to implementing PCAF and greenhouse gas reporting, it's important that Super Easy sets clear targets and adopts key milestones in its pledge.
Setting manageable targets is essential to tracking progress. Based on IPCC forecasts, we recommend targeting a 40% decline from 2010 levels by 2030, which will also allow us to target net zero by 2050. We do acknowledge, however, that there is a probability that we may fail to reach net zero by 2050 if emission reductions by 2030 lag at less than 25%. As such, we endorse Super Easy pledging negative emissions by 2070 to provide additional long-range value alignment with younger members. Moving on to slide 8, we note the actions and outcomes surrounding the 5-year transition for a smooth stage 1. The highlights include providing time for companies to adapt to the changes, the opportunity to solicit feedback from constituent companies, and time to allow for realistic commitments to be attained.
Moving on to stage 2, we will look to shift towards the 2027 target portfolio. This includes reallocating away from Australian equities and in developed markets. Reducing initial exposure to Australia has an immediate gain to the portfolio's absolute emission goals, as Australian industries pollute more on average than their international counterparts. We believe this is due in part due to a regulatory landscape that is soft on polluters, coupled with a lack of renewable energy targets in key Australian states such as New South Wales. We also suggest an overweight on developed market equities, given a large portion of emerging market equities, including China and India, are not forecast to reach net zero by 2050. In addition, emerging markets have been contributing to 95% of greenhouse gas emissions growth over the last 10 years.
Developed markets also present a more attractive relative valuation against emerging markets. Additionally, we recommend underweighting fixed income for stage 2 due to near-term interest rate sensitivity risks. Overall, the stage 2 reallocations towards a 2027 portfolio will lead to a major 35% reduction in emissions while improving risk-adjusted returns.
Moving forward to stage 3, which is anticipated to begin in 2033, we recommend expanding allocation towards alternative assets to help achieve net zero and enhance risk-adjusted returns. Long-term allocations towards the 2045 portfolio involves overweighting infrastructure and private equity. In particular, Super Easy should look to tilt early towards renewable infrastructure, as an additional $3.5 trillion per year is needed to reach net zero scenarios, culminating to $9.2 trillion per year. In addition, overweighting private equity enhances Super Easy's ability to invest early in assets supporting emerging, innovative climate tech, such as carbon capture and storage. And this is because 35% of private equity assets are in the tech sector.
And as part of our longer-term allocation, we also suggest underweighting real estate due to physical risk. We would look to reconsider our underweight recommendation when low-carbon construction and energy offset regulations begin to gain greater traction. Over the long term, overall, the long-term drivers behind stage 3 allocations towards the 2045 portfolio will lead to a further 48% reduction in emissions relative to 2022. These stage 3 allocations will also lead to an increase in the Sharpe ratio from 0.98 to 1.07 between 2027 to 2045.
Finally, moving on to stage 4, we note that it will be necessary to offset a portion of the portfolio as the underlying portfolio assets move towards net zero. Although aggressive modelling can see a potential pathway to net zero without this stage, we believe it will be a more conservative and practical approach for Super Easy to implement a direct offset purchase program to begin retirement in 2045 in order to meet its obligations under the 2050 pledge. Starting this program as early as possible will be advantageous to Super Easy, as carbon credit prices are predicted to rise by more than 11% per annum in Australia, from $30 today to a forecasted peak of $560 by 2050. Given the long tail cost of trying to directly buy the offsets in the sunset years, we believe this cost to be untenable if not started early, with our analysis putting the cost at over $5 billion per annum between 2045 and 2050. At present, the current offset plan is estimated to cost less than $2 billion over the complete 24-year rollout, ultimately culminating in a complete portfolio decarbonisation by 2050.
Taking a look at some key considerations, we see the proposed decarbonisation plan should offer an easy sell to members, a simple solution to the board with the opportunity to expand fund size and improve its reputation as an industry leader. In addition, there is support in place from the Australian government and its key superannuation regulator, the Australian Prudential Regulation Authority. Internally, this should represent business as usual for asset managers, with simple modifications to compensation arrangements offered as a solution to further alignment.
Finally, just taking a look at the broad risk considerations, we've highlighted the key issues as they impact each stage with an evaluation of the likelihood of occurrence and impact in terms of effect size. However, given the wide-ranging threats of decarbonisation initiatives, an extensive risk assessment is available in the appendix and is available for review and Q&A.
So just quickly to conclude, Paragon Capital recommends Super Easy adopt a broad four-stage framework to assist in its decarbonisation efforts by 2050. By employing our proposed initiatives, Super Easy can look to mitigate or completely offset significant physical and transitionary risks associated with climate change. In addition, attractive option value exists in moving early into key assets that will likely experience growth, limiting investment risk concerns, while providing sustainable impact that will more closely align with the needs of younger members over time. We thank you for your time, and we now open up to any further questions.
Thank you so much, Paragon Capital. Excellent presentation. We will now be moving into the Q&A. So judges, who would like to open with the first question? Francis, please go right ahead.
Yes, thank you, everyone. Great presentation for this very complex problem. You seem to have identified a solution that is a win-win. Basically, you decrease carbonization, and at the same time, you increase the risk-adjusted return of the portfolio by having a Sharpe ratio that increases constantly. Can you explain a bit more how you get to this second sort of objective of not only keeping the expected return of the portfolio, but increasing the risk-adjusted return?
Yeah, I might grab that one, if that's okay, guys. So yeah, obviously the key part of this whole plan is that it needs to be a win-win. And we believe that that's the only way to effectively manage this transition is to offer advantages to all the stakeholders involved. We think that that's really essential to the whole process, is getting the alignment right. Now, in terms of that rising Sharpe ratio, if that's sort of the main crux of the question there, Francis, is that correct? Yep. So the reason that Sharpe ratio sort of rises a lot in the beginning and then moves towards the long run rate of just over 1 is that our model actually is forecasting in a higher risk-free rate in the short term due to obviously the inflationary concerns of the current market. And so obviously that quite negatively affects the risk adjusted returns that we have. And when we actually obviously start, we're actually working with the case weights. So we're working with the portfolio that was allocated to us within the case. Now, when we actually shift away from that into a portfolio which has a higher equities component, and then obviously into a higher alternative assets class later into the scheme in stage 3 and in stage 4, then we see that Sharpe ratio continue to rise as those expected returns associated with those categories are going to be a little bit higher.
Victor, you're on mute.
Apologies. So it goes back, I just wanted to quickly add that it goes back to the themes that drove our allocation in terms of reducing climate risk and increasing climate opportunity. So we anticipate to capture the demands, things such as demand shifts, and so that will be a driver of returns, but also mitigating risks such as the risk of losing financing because finance is losing the appetite to finance high emitting companies. And so that sort of decreases, we anticipate to decrease risk of our investments while capturing the upside with the shifting in demands.
All right, thank you very much, team, for your response, as well as for Francis for your question. Our next one comes from Jamie. Take it away.
Thank you. And I have, I guess, a few questions. So just building on the previous question, could you just articulate what are your investment beliefs related to transition risk, and how did you, based on those beliefs, integrate it into like your portfolio construction?
Sorry, Jamie, just to sort of better clarify on that question, you're sort of wanting to understand how we thought about transitionary risks broadly, or as it pertains to particular asset classes?
Both, but just looking to get more clarification on, what are your investment beliefs? And then based on that, how did you use that information to determine how you would express views into your allocation framework?
Sure. Victor, can we have 45, please? before that. It's either, yeah, no, two more. Go back the other way. Go right to the end. Sorry. No, yeah, keep going. Keep going. Yeah, that one. Sorry, I was just trying to get up the Australian government's tracking plan for basically their innovation pathway. So a lot of our assumptions for our model were built on what technologies we anticipated were going to largely drive market trends. So in terms of the obviously largest transitionary risks, the biggest sort of component that we were kind of looking at there is looking at what are going to be the stranded asset risks associated with particular industries. You know, thinking about materials in particular, thinking about some of the larger fossil fuel projects, and sort of looking at how we could mitigate exposure to those stranded asset risks. Now, sort of taking a step backwards, you know, we could also look at where are the gains going to be had in terms of benefiting from those transitionary risks exposures. So obviously looking at industries that are going to expand as abatement kind of improves, and there's an opportunity to access greater carbon credits within the markets, and sort of looking at where the returns might progress in terms of forestry land, in terms of you know, the methane conversion processes that exist within industry, and sort of we were looking to sort of broadly look at what were going to drive those, you know, secular industry trends, and from there we sort of backfilled from a standard sort of 60-40 portfolio to sort of think about where we would end up long term, and obviously we figured that the only way to capture that, a lot of that innovation, was to expose ourselves to greater infrastructure, private equity, and then the, you know, sort of surrounding alternate asset classes, particularly in the domestic markets long term, but obviously in the sort of developed markets outside of Australia in the short term.
So Alex has talked about the innovation sort of there, but I just want to quickly add, in terms of transitionary risk, we also want to sort of consider the policies that we anticipate to come online, such as carbon taxing. And so as a result, we would, that's a large justification as to our allocation towards greater sort of renewable infrastructure. And
all right,
can I just quickly
sorry.
confirm?
Victor, just to tell you that your slides right now are not showing.
Yeah, am I allowed to stop sharing and reshare to get the slides back on? Because I think...
No, that's all right. We can continue with the Q&A. The judges also have a copy of your slides, so perhaps you can direct them there. But can we move on to the next question? I have one here with Gareth.
Hello, thanks for the presentation. I'm just going back to I have one question and one comment, really. The questions around the actual mandate about maximizing your risk-adjusted returns at low management costs. And as you think about the program in your 4 stages and getting to, 4 stages out, getting to allocating more to privates, how do you think, are you changing that mandate and how you're thinking about it? Or is the management cost being offset anywhere else? And then just a comment on your slides, and I know you try to pack everything in, but it was extremely busy and there was a lot of information certainly to try and capture. So that's just the one comment, but thank you.
All right, who would like to take that question?
Sorry, so you just so I understand correctly, you're asking about how the sort of potential greater weightings into that private equity market is going to change the risk-weighted or the risk-adjusted returns profile that we currently set out to attain. Is that correct?
I'm thinking a little bit broader than that, which is your mandate, right? I thought it was risk-adjusted returns, but at a certain management cost.
Yep.
Right, a fee. So how do you think about, because private assets are pretty expensive, when shifting to more kind of infrastructure and some of the other private assets?
So just broadly speaking, our allocations were actually based on index pricing anyway. So we were looking at low cost alternatives through every stage, basically looking at in every sector apart from specific private equity exposures. And within that private equity, we considered whether or not there would be a sort of a fund-to-fund allocations model, or whether we would actually use a direct investment model going and lodging those, venture capital type investments. But, ultimately we decided that it was very hard to quantify in terms of the risk profile long-term, what that would look like. And so we obviously basing those allocations on index return values at this point in time, because we wanted to maintain the low cost structure of the fund. In terms of broad impacts in terms of cost, we don't anticipate there's going to be any large shift in its current management fee structure. There is a minor fee increase associated with physically going out and conducting the transitionary program. But as we highlighted on slide 12, that cost is only going to be a couple bucks per member, which obviously, we're looking at a median fee cost in Australia of about $168. So, going from 168 to 170 is not going to be something that we anticipate is going to cause any members to lose any sleep.
All right, sounds good. Thank you very much, team. Victor, right now you can actually drop the screen share and reshare your slides. But in the meantime, perhaps the rest of your team can tackle this next question coming in from our judge, Mohammed. Please go right ahead.
Hi. Impressive presentation. Congratulations, guys. I have a couple of questions around the quantitative modeling that you use to support your analysis. First question is around the carbon footprint calculation. What kind of assumptions did you use for private asset classes? Or more broadly, how did you manage, the constraints around data to run your quantitative modeling? And also, what type of scenario analysis you've done as you've run your projections, simulations, and so on? Is there any type of scenario analysis, stress testing that you conducted to support the study?
I might just quickly tackle the sort of data in terms of where we got the carbon footprinting. The data that we relied on was mainly what was publicly available, and based on providers such as S&P Global. They give items such as carbon intensity on a standardized basis, and based on the industry, we would make broad-based assumptions to derive an absolute measure, and then assume a decrease on that based on other pieces of research. And for example, and for our fixed income and sovereign ones, we would rely on country emissions.
And just to tackle that last part of the question, we did do a bit of scenario analysis. We have an appendix slide where it's a business as usual slide. If you could take us to there, Victor. And what you can see here is that if we don't adjust our weights, according to our stages and our mandate, you can see that we don't hit net zero by 2050. And I do welcome and open to the floor if anyone wants to add anything on top of that.
And I guess the key thing is that the slower your portfolio transitions to net zero, the more emissions that you're ultimately going to put out there. So there is a significant impact if we don't shift the portfolio to the target one.
Just one quick point in terms of how we actually built it up. Obviously, we started with a weighted average carbon intensity metric, and then we backed out the data to an absolute emissions basis, and that's how we're actually tracking emissions decline over the entire term. And just with our broad-based assumptions, it's obviously pretty hard to make any specific assumptions about how the model will look 15 or 20 years. It's very crystal ball stuff, as I'm sure many of you can appreciate. But we did obviously work with the Australian government implementation timelines to match it as well as we could with the current regulatory framework that exists within Australia, to look at what they anticipate the desired levels are going to be to meet the sort of the policy cliff requirements.
Yeah, and I think you do bring up a really good point. You made the point about gathering the data that you need to be able to make these assumptions. And in areas where we did struggle to gather data, the right set of data, for example, was in emerging markets. We do have an appendix slide on this as well. Point being, that lack of data availability meant that we ended up overweighting, developed markets relative to emerging markets. And there's other reasons as well, and we're happy to go into other reasons as to why we overweighted developed markets relative to emerging markets.
All right, thank you very much, team, for that thorough response to the question. We have around 5 minutes left in Q&A, so let's be concise. Move on to another question from our judge. Kelly, please go ahead.
Thank you. Firstly, congratulations on making the top 5. My question is, if we, Super Easy, adopted your proposal, what would be the biggest challenge for us in implementing it? Again, I would like to end my question by saying thank you again for your great work and this presentation. Thank you.
I guess it really comes down to stage 1. And I guess that's the start of our stage that we propose to Super Easy. And the key risk with that would be adoption risk. It's getting the portfolios to align with measurement, because that ultimately is the tracker of how we measure the portfolio's emissions. And so if we aren't able to achieve that, then the rest of the plan would essentially fall apart.
Yeah.
And adding on to that, sorry for cutting in, we did set a 5-year horizon for stage 1, and that is to allow us that extra gap to transition gradually and build up capabilities. 5 years is a realistic goal because Super Easy is a big super fund, and as we say for all things, good things take time.
Yeah, and I really appreciate you bringing up what the key risks are, because we have considered the risks and we also have considered mitigants for those risks. So one of the key risks in stage 1 is those laggards. The lag is adopting accounting methods. So one of our solutions, we have various solutions, but one of them is stressing that net zero is coming and the need to adopt it, because a lot of the biggest asset managers have their net zero pledges as well. So all the other asset managers are doing so. The other one is that we can gain board control, and this is another carrot in terms of a mitigant to that laggard risk. And in doing so, we can leverage our ESG insights and also act as an active steward to drive the ESG operations of that firm to stay on track.
All right, thank you very much, team. I believe we have time for one more question, so I'll give that to Vincent. Go ahead.
Presentation. Just quickly, can you tell us a bit more about your thinking regarding timeline? When looking at your stage approach, it does seem that some of the actions are taken later in time, such as tilting to renewables or shifting the portfolio and engaging with portfolio companies to a certain extent. So I'm just wondering what's your thinking behind sort of the wait and see approach for the first 5 years, and then the timeline for the next stages. Thank you.
Yep. So I might jump in on this one. So obviously the key part about all this is that everything falls apart if we can't get other businesses aligned. The key part about us reaching net zero is our role as active stewards. Now, we think that allowing time early in the piece to engage that feedback and really make sure that we get attainable targets from constituent investments is going to be really important to how we actually can track and then drive progress towards that. Now, obviously, there's a bit of flexibility in terms of how we actually, those dates are not set in stone. If we have a monthly review would be built into our asset allocation framework. Now, if we decided that there was going to be sufficient opportunity to alter those weights, there is built-in flexibility to actually allow for that, as every sort of asset manager would work with. Now, in terms of would we potentially move some of that renewables, earlier in the piece? Of course, if the opportunity presented to decarbonize effectively without compromising the risk-adjusted return, we would absolutely look to get there as quickly as we possibly could. But I think that we want to be conservative, because with a big fund and a lot of capital to allocate, we don't want to move too quickly and move too hastily, lest we obviously compromise and incur additional, tracking risk or other benchmark related risk associated with being a very large fund. Obviously, we would like to be included as part of MySuper. And so, key consideration there is not doing too much too fast, lest we deviate too much from the standard and cause problems there as well.
All right, thank you very much, team. Unfortunately, that's all the time we'll have for your Q&A today. So once again, congratulations on being a finalist, and thank you to our judges for your questions. We will now be taking a momentary break before we welcome on our next team, APM Capital.